Welcome to Econoday Unplugged. Today is Tuesday, June 13th. I am Ann Picker, Econoday's chief economist, and with me today are Jeremy Hawkins in London and Mark Pender in the Poconos. This week we have a trifecta of central bank meetings. Wednesday brings the Fed, Thursday the ECB, and Friday the Bank of Japan. Jeremy, a very busy week in Europe and in the UK.
It is, and I suppose we've got to say that the two big focal points as far as European investors are concerned, as you mentioned, the ECB meeting on Thursday, and we got some important Brexit bits and pieces trying to go through Parliament as well as I speak. Kick off with the ECB. Well, interest rates aren't going to be in focus this week, but the quantitative easing asset purchase programme certainly is. Why expect anything? Well, we'll get updated economic forecasts, which may provide some fundamental justification for a change in policy. Although I must say, given recent data, I doubt that. But more importantly, of course, they're simply running out of time now before the current programme reaches its soft end date in September. Why I don't expect much? Well, the core inflation is still only 1.1%, and second quarter growth is looking decidedly sluggish. On top of that, of course, now we've got this political instability in Italy and to a lesser extent Spain. And that's made the peripheral Eurozone markets all the more vulnerable to any kind of reduction in ECB support. So the options then, well, they can do nothing, just maintain the current pace of net asset purchases of 30 billion euros a month through at least September, and perhaps signal an update to what they intend to do at the July meeting. They could announce a tapering beginning in October, but offer no explicit end date for the programme. Or if you like, go the whole hog and announce a definitive date for the ending of quantitative easing purchases altogether, possibly December, with or without a tapering period in the interim. Now, how are the markets going to react to any of those? Well, I think from some of the price action we saw last week, particularly on Wednesday, when we had almost a mini US-style taper tantrum taking place, when we had some comments from the ECB just really talking about the possibility of tapering, announcement of tapering at this week's meeting. From reaction there, it's suggestive, I think perhaps markets aren't quite ready yet for some form of tapering at this stage anyway. So in other words, then if we see no change in policy, that should be taken quite well. So the euro will probably trade lower on it, but bonds should trade higher, and spreads between bonds and the periphery is narrow. If we see option two, so we get a tapering and no end date, well, that's not great for bonds, but it's okay for the euro. We'll probably see spreads widen. The really interesting one would be that if they come out and announce a definitive end date, particularly if it is, let's say, December, then that, of course, would open the door potentially to higher interest rates, because they've announced no change in interest rates until well after the end of the quantitative easing programme. So if they effectively come out and signal its conclusion at the end of this year, for example, that will be seen as opening the door to perhaps ECB outright tightening in terms of interest rates at some point in 2019. That should certainly help the euro. It will certainly hit the bond market and potentially the equity market as well. And we could well see some of these smaller Eurozone bond markets, the likes of Italy, Portugal and Spain, perhaps being hit quite hard. So there's going to be a lot to look out for in Thursday's ECB meeting. And one thing I should quickly mention with regards to that is to keep an eye on what they do with forward guidance, because how they sell any kind of move is going to be particularly important. With regards to the UK, just ignoring the numbers, it's a couple of big days for Brexit. Essentially, we've got the government trying to reverse some 15 amendments to its EU withdrawal bill, Brexit bill to the rest of us, in Parliament over the next couple of days. And they're struggling to find enough votes to do it. That said, and we still got both major parties really split over Brexit, so the outcome's unclear. The government's already lost its Justice Minister this morning, who resigned over the whole issue. And although it's supposed to be just a one-day vote, it's had to be extended into 2 days. On paper, at least, if the government were to lose this, it could actually lead to the government falling. I think that's pretty unlikely from what we seem to be hearing at the moment, but certainly it's something which investors have got to be alert to. Even if they get through today's votes and tomorrow's votes, there's still more issues further down the road, but this could be a potentially sizable stumbling block. So lots to look out for over here.
Jeremy, smart.
Yep.
It's why, if the economy is slowing, are we getting this withdrawal of support or expectations for it?
A very good question. I think it's getting to the stage now that this program has been running for so long that they're starting simply to run out of assets they can actually buy, because it's getting to the stage where owning so much of these Eurozone bond markets that they're going to start finding fresh assets to actually purchase. Also, there's a number of members on the ECB Council, notably the Germans and the Austrians, who really take the view that, look, we've been pumping in so much money for so long now, it's simply a matter of time before inflation goes up and potentially gets out of control. Now, I suppose the thing in their favour is to say that although the economy has certainly slowed, it's slowed from what was, by Eurozone standards, pretty high rates of growth. So I think, by and large, perhaps you could say almost a neutral view now would be to get towards the tapering side, whereby it's not the case they're pulling out QE. It's not we're getting into the Fed type stage whereby, they're withdrawing the assets, or the money, I should say, they've actually put into the economy. All they would do would be no longer putting any fresh money in. So it'd just be a move towards stability. And it's something which is going to have to happen sooner rather than later, I think.
And how much have they actually bought?
Oh, they bought trillions. We're up around about 2 trillion or so now. So we're talking about, a sizable amount of money they've injected.
Thank you, Jeremy. Mark, Fed watchers will be closely reading the tea leaves, also known as a dot plot on Wednesday.
That's right. We're getting quarterly FOMC forecasts. And any change in the unemployment rate, in GDP, and the number of rate hikes that they see could make significant, actually would be probably the market-moving news, since a 25 basis point rate hike is universally expected. Our backdrop, in sharp contrast to Europe, is of strengthening economic data for the most part. I think the one that's the critical, you can't overlook it, is the withdrawal or the decline or the reduction of the available workforce. We're getting all sorts of confirmation of an unusual degree of labor force participation in the economy, drawing down who's available for work. And even though it hasn't yet started any kind of wage inflation of any significance or any acceleration, certainly the risk is there, and there's really no other place to find new workers, and the lack of new workers really does pose a risk to business, regardless of inflation. It poses a risk to business expansion. Businesses won't be able to find the people they need to get the work that they need to have done. We're also having the Jerome Powell's second press conference, and that would certainly be of interest to see if he starts developing a personality that we can define a thumbprint of a Federal Reserve chairman that we can establish. And so it looks to be a very busy week. And this morning, this is June 12th, the summit between the U.S. and North Korea is winding down. Looks to have been some concessions on both parties, a denuclearization of the peninsula. The markets here look to be pretty calm. A little backing up in interest rates, which shows that there's U.S. interest rates, which shows that there's less demand for safety right now, which is good news. We're getting also the consumer price index this morning. Now, that's always a wild card. I mean, it could be that we're going to find some pressure. A little bit of may occur in the CPI core. Expectations are for a moderate report, but that surprise there would underscore the Federal Reserve's efforts now to really to bring up those interest rates and establish a conventional withdrawal of support, given the expansion here is quite long, quite old.
Mark, the Fed doesn't use the CPI as their inflation target measure, however, and doesn't the PCE run a little lower than the CPI traditionally?
It does. But it's the direction of that is of importance here. The different methodologies give the PCE, which is updated more frequently in its adjustments and its basket of goods and services that it tracks. It gives it about a half a point, several percentage points above the CPI, but like right now the CPI is over. The core right now is at 2.1%, as opposed to the PCE, which I think is 1.9%. But the CPI, of course, runs 1 month ahead, or when the CPI comes out, it's going to be about May. The last PCE we have is on April. So if there is a little bit of a pressure here, that will signal will directly signal an increase in the PCE. And again, it's the direction that we're looking at. The inflation has been flat, marginally, incrementally pointing up, but not to any degree. Now, if that slope, if it's a CPI or any of the inflation indicators, even the PPI, which we get later, or even import prices, which we get later this week, if they all of a sudden start turning up, then that would be a signal later that the PCE in turn would also probably go up.
Thanks, Mark. The last of the trifecta is the Bank of Japan, which is expected to leave its policy interest rate unchanged at minus 0.1%. Bank of Japan Governor Kuroda continues to signal a newfound acceptance that deflation is a tougher adversary than he thought. And in talking about unemployment and scarcity of workers, Japan has actually begun to allow an inflow of workers because their unemployment rate is now 3.2%. The BOJ is expected to debate whether structural factors are behind the recent disappointingly slow inflation. This could force them to cut the bank's price forecast at their quarterly review in July. Core consumer price inflation for Tokyo, a leading indicator for national trends, hit all of 0.5% in May, and a sign that the economy is lacking momentum to drive up prices. The softness inflation could also force the BOJ to shun any talk of whittling down its massive stimulus program, which really dwarfs the U.S. and European programs there. Expectations are for the BOJ to keep its monetary settings unchanged and maintain its view that the economy remains on course for a moderate expansion, even though growth contracted in the first quarter. And disappointingly, the first revision showed no inclination to change the negative growth.
And can I ask you, if they're talking about potentially reducing their inflation forecast, are we talking about yet more easing coming out of the BOJ at some point this year?
I'm sorry?
If so you mentioned that the BOJ may have to reduce its inflation forecast at some point.
Right.
Does that mean they might be forced to ease yet more before the end of the year?
Well, I think they're in a position where they can't ease more simply because there is an insufficient amount of securities that they can buy. And they really don't want to. So they're caught in a very interesting position while the ECB is finding a similar situation. It can't seem to find bonds to buy. And similarly, even though the Bank of Japan buys ETFs and the like, it's still running out of securities to buy. So they're sort of caught there. All right, guys, let's leave it at that.